up here. So I'm going to give you a little bit of highlights as to what the main strategy development was in Europe. First of all, indeed, very interesting growth across all the different strategies in Europe. And indeed, what we see is that indeed the majority of these slides have been definitely growing in view of the very interesting policy push that we've seen that has promoted sustainable and responsible investing, not only at European level, at the broader European level, but also at member state level. Of course, you're all very familiar with Article 173 of the French Energy Transition Law, which clearly showed how legislation at a country level can represent a true game changer for the industry. It also showed the strategic relevance of strong legislation at national level and the extent to which this can be a useful example to influence European dynamics. And indeed, it did spur growth that we were able to observe throughout the European context. Exclusions continue to remain also in Europe as the main asset, as the main strategy, with indeed over $11 trillion, with a huge rise by 48%. And indeed, we continue to see this very interesting trend that continues and which is going to continue to grow into more divestment following the debate around climate change, of course. On second position, we see non-based screening, which stays at 5.5 trillion, growing up to 40% from the previous review. On an interesting note, the engagement and voting strategy, stewardship in the UK, is definitely very strongly positioned there. And this also has to do with, again, it ties in with the policy debate at European level, which last April culminated in the Council's adoption of a directive aimed at strengthening shareholders' engagement across big European companies. I think it's important to mention that this directive, the Shareholder Rights Directive, puts specifically emphasis on the specific requirements in order to encourage shareholder long-term engagement and increase in transparency. The requirements mainly relate to remuneration of directors, identification of shareholders, facilitation of the exercise of shareholder rights, and transparency of institutional investors, asset managers, and proxy advisors, mainly in their own relationship. Although the assets remain small at $107.2 billion, impact investing, as already has been mentioned for the globe, but also for Europe, remains the most dynamic approach for investors in Europe. And I believe we're going to continue see this interesting growth to continue, because indeed now the whole discussion around SRI is more going to from process work towards a more impact assessment. I think that the SDGs and the work that investors are going to continue to be doing around the Sustainable Development Goals will even make it so there will be more growth in that respect. Also very interesting perhaps is to mention that sustainability themed investments have also profited from the series of high-level agreements that have pushed sustainability and climate change to gain prominence in investment strategies. And after impact investing remains indeed the fastest growing strategy in Europe as well. Developments to watch, indeed, as I mentioned, the policy issue, there have been quite a few positive developments for our industry at European level. I've mentioned already Shareholder Rights Directive approval, but indeed there have been other directives which have once again approved the importance of the integration of ESG criteria in the legislative framework at European level. And only last week we had the Capital Markets Union midterm review, which was very successful in proving to be a manifesto for sustainable finance and a responsible investment. The European Commission took this opportunity to once again state their commitment towards a re-engineering of the financial system to become more sustainable, integrating ESG and align with the Sustainable Development Goal as part of the UN 2030 agenda to strengthen the EU leadership on sustainable development. The key issues that have been identified in this sense are the clarification that fiduciary duty of asset owners and asset managers includes the integration of ESG in decision-making, ensuring that sustainability is more central to corporate governance, and promoting better integration of ESG performance, initial ratings, and key market benchmark. On this note, I would like to remind our audience that the European Commission has decided to set up at the end of last year a high-level expert group on sustainable finance, the aim of which is really to define a more sustainable financial market system, so if you will, a more sustainable capital markets union. And this group, of which Eurosif is an active member, will come up with a report on the 10th of July. This will be the interim report of the group, which will be again presented on the 18th of July during a public hearing to be hosted in Brussels by the European Commission. And then will follow also a public consultation. So I invite you already to submit your feedback once you'll have the possibility to do so for this consultation. The final report with the policy recommendations that the high-level group will submit will come out at the end of the year. I think that's all for me. Oh, no.
Simon, this is Lisa. Can you hear me? Simon?
Lisa, I hear you now. Let's just, if you just sit quietly for a while. Flavia, you've got one more slide on leading styles in individual markets.
We're going to show you an overview of which ones have been the biggest, most interesting strategies across the different European countries, just to give you more a flavor of how the evolution has moved across the different member states. So indeed, the largest markets, once again, confirmed to be France, with 3.1 trillion, Germany almost at 2 trillion, and the UK at 1.6 trillion euros. And indeed, what we've done is we compiled this table just to show you which ones were the biggest styles in terms of assets under management, apart from exclusions, because indeed exclusions keeps on coming back in almost all the member states as the most successful strategy. I think I can give the floor to Lisa now. Simon?
Yeah, Lisa, can you hear me? Lisa in America?
This is Lisa. Hello.
Okay, Lisa, over to you. Your picture is up. Yeah, I think we can hear you. Off you go.
That is, well, with apologies to everyone on this call, we share a common language among all of us, but we clearly do not have the same understanding of technology this morning. So anyways, very nice to be with all of you. This is Lisa Wall. I'm the CEO of US SIF. Meg Voorhees is also here, and I'm just going to run you through some of the United States and Canada highlights. And so you can see that in the U.S., much like other colleagues on this call, from 2014 to 2016, we had quite an increase in assets that rose 33% from 6.57 trillion to 8.72 trillion. 8.10 was held by institutional investors applying ESG criteria to portfolios, and about 2.5 trillion was held by institutional investors and investment managers that filed or co-filed resolutions on ESG issues of publicly traded companies. And so that, of course, is probably something that is the most vibrant in the U.S., our shareholder process. It also, and we can certainly talk about this during questions, it's also something that's very much at risk right now with some issues related to the Choice Act moving through the U.S. House of Representatives, and I think that's something of great concern to investors around the world. The report, when eliminating double counting for assets involved in both strategies, did bring us to 8.72 trillion, which is nearly 22% of assets managed in the U.S. And ESG integration is most widely used strategy, affecting 6 trillion of SRI assets. What does that mean? It means that respondents said they did ESG integration, which when you drill down on that, you'll find that different firms mean different things when they use the term ESG integration. Another topic that I think is a great one to explore further. In the U.S., well, each day, we have many new developments to watch. One of the things we're looking at is the Department of Labor ERISA guidance on shareholder rights and economically targeted investments, to see what happens with that. In the new administration, of course, the U.S. has pulled out of Paris, and so we're moving to do that, and we're certainly focused on climate and renewable energy finance, as well as a multiplicity of other pieces of public policy that has a potential impact of sort of moving us back on environmental, social, and governance issues. In Canada, assets managed using one or more responsible investment strategies increased to 1.09 trillion in 2 years, which was a 50% increase. The dominant strategy, again, you'll see this here at a much smaller level, but nonetheless, was ESG integration, followed by corporate engagement and shareholder action. And the top 3 engagement issues included executive compensation and supply chain management. Impact investing continues to be a small category in Canada, with assets standing at $6.7 billion, growing 123% since 2 years. And in Canada, developments include new reporting requirements under Ontario's Pension Benefits Act. Other provinces may do something similar. I think what's interesting here is that well, there's a lot of issues to discuss, including ESG integration, the effect of policy across different countries, as well as what impact investing actually means within different contexts, which I'm sure everybody on this call grapples with to some degree. With that, I will turn it over to my colleagues and be available for questions now that we've figured this out. So thank you for bearing with us.
Okay, thanks, Lisa. Simon O'Connor will come for your slides on Australasia and Asia.
Right,
again,
we'll
if you
just get the slides moving back down there. So I'm going to give you a bit of an insight into the Australian and New Zealand markets. That's the primary markets that I represent, and then I'll give you a bit of a flavour for parts of Asia as well. So another market where we've seen really strong growth, very similarly to Canada over the last couple of years in Australia and New Zealand. So we've seen a really strong uptake across institutional investors across Australia, and the very large bulk of this uptake has been around ESG integration again. And we have, as I said earlier, about 1 in every $2 invested in Australia now is invested under a sustainable investment strategy, and probably around 95% of that is under ESG integration. So really strong growth. It's probably important to note that what's included there under ESG integration is not just simply those managers and asset owners who state they do ESG integration, but in fact, we do a really detailed assessment of about 90 fund managers across Australia and New Zealand, rate them all on the level to which they integrate ESG factors, and only include those who can clearly exhibit a leading approach that is effectively score over 80% in our framework. So of that, we still have around conservatively around $500 billion managed under responsible investment strategies. What that really masks, though, is in the smaller ethical or SRI or negative screened and sustainability themed investments, we've seen a doubling of funds flowing into these strategies in the last 2 years. So really rapid growth, and that part of the market is very much driven by the demand side, particularly by retail demand, but also private wealth markets that are really switching their investments to more of a sustainable approach. Again, in Australia, like many of the other markets, the impact investing remains small but emerging very rapidly with very significant growth rates. Equally, the fastest growing category in Australia in particular has been sustainability themed investments, driven strongly by low carbon strategies, green property and sustainable agricultural investments. So some really strong story there. I think what's becoming more interest in the market is that whereas there used to be ESG managers and negative screen managers, what we're increasingly seeing is large institutional investors, both asset managers and asset owners, who are employing multiple strategies, ESG integration combined with corporate engagement, combined with negative screening, plus some allocations to impact, plus some allocations to sustainability themes. So the categorization becomes increasingly difficult, but I think that is reflective of an increasingly sophisticated marketplace. That the best example of that, I think, in the Australian market in particular is the tobacco divestment that has really moved through the market very rapidly over the last couple of years, whereas around 35 of our largest asset owners have sold out of tobacco stocks in the last couple of years. And it seems that particular focus is now being exported to parts of Europe. So there seems to be a bit of a flow on in the tobacco divestment area now. Whereas in Europe, a lot of this was driven by the policy side. I think it's fair to say that in Australia and New Zealand, this is largely driven by the investment community, with the policy struggling to keep up. There have been some movements around both the ASX corporate governance codes and more recently in the last few months, the New Zealand NZX corporate governance codes that have really pushed improved disclosure around ESG for issuers, for listed companies. And that's certainly helping to move things along and helping to inform investors across ESG risks. So a lot of interesting developments going on in market. I will just touch briefly on Asia, both Asia ex-Japan, but in this first slide. And now this is data that was kindly provided by the Principles of Responsible Investment, who ran a survey of Asia ex-Japan. And we see there some growth, smaller levels of growth, to around $52 billion of assets under management, with ESG integration again being the leading strategy, about half of the total, and then negative exclusion risk screening being the next. So we do again see some common story here, a strong growth in sustainably themed investments. So what we hear, I guess, in the marketplace is there is an awareness rapidly flowing through the markets in Asia, where this is starting to become a bigger part of the investment strategies. So I think one of the big drivers that we'll see over the last couple of years, and certainly green infrastructure, renewable energy, and a really strong interest in green finance. And we've started seeing some quite significant sized issuances of green bonds, for example, all as part of the Chinese government push towards lower emissions energy sources and clean energy. So I think we'll continue to see that particular growth. We have some good data now from Japan as well, provided by the Japan SIF, who have been doing surveys for the last couple of years and who are really mapping what is quite an interesting market right now and quite a strongly emerging one in sustainable investment strategies. We see really significant growth there. That's partly due to a methodological change where the survey from Japan SIF has incorporated more of the market. What it does indicate is we're now looking at a market that has a very large uptake of sustainable investing strategies. Certainly the Japan Stewardship Code that's been in place for a couple of years now has been a big driver of that, and is one that is really being emulated in other markets around the world. And also probably more recently, the leadership shown the Japanese government pension investment fund, one of the world's largest pension funds, having really taken some significant steps into responsible investing and sustainable investing, is really shifting the market now. We're finding that much of the market is now following behind the GPIF. So that's another market to really watch this space. I will pass it on back to Simon to moderate questions. Thank you.
Thanks very much, Simon. We've been joined by Meg Voorhees, who I think edited the report from America. Meg, can you say a few words? Can you keep it brief? We're already slightly over time and we've got questions coming in. So over to Meg. Over to
Sure. That That's fine. I'm sorry we wasn't able to sign on in time for the overview, but Simon O'Connor did an excellent job. And I thought as we move into the question period, I'm anticipating 2 questions that people might ask, and I just wanted to make 2 technical notes. One is that as much as possible, we try to use a constant exchange rate to the dollar. So with the exception of Asia, ex-Japan, all of the local currencies were converted to dollars at the exchange rate prevailing at year-end 2015. So we're using that kind of constant exchange rate, so you aren't seeing exchange rate fluctuations in these growth figures of sustainable investing from 2014 to 2016. And the other question we get asked a lot is, if you look at the assets that are involved in each of the 7 sustainable investing strategies we discuss, you look at 15 trillion involved in negative screening, more than 10 trillion involved in ESG integration, 8 trillion involved in corporate engagement and shareholder action, you would rapidly get to a total that's much greater than the 23 trillion we give as our global sustainable investing figure. So it's important to note that that 23 trillion global figure is a net figure, that many of these assets use more than one strategy. We have overlapping strategies. So with that, I think let's turn it over to questions, and I'm so pleased to join you all today.
Has come up in a question pitched to me. We have got lots of questions coming, so I think an important one, it has come up on impact investing. I'd invite all the chief execs to answer, but please keep it brief. The question is, how do we preserve the quality of investment and ensure that its definition is well understood and widely applied? Now, we could have a webinar on that in its entirety. I think what we want to know from each of the regions is the definition actively being discussed? Is any clarity emerging? Lisa, in America, do you want to start on?
Yeah. Sure. Can you hear me?
Yeah.
Simon?
I hear you.
Okay.
Yeah.
So yeah, we okay, good. No, I now go to every meeting that's got impact investing in its name and say, what are we all talking about, so that we all have a sense that we either are having the same conversation or a different one. You know, in the U.S., we define impact investing as across an all asset class approach, recognizing that there still is a part of the community that sees it as direct or private equity investments. Even our own trends report, the global trends report, in order to create some consistency across the world, talks about impact investing as a kind of direct investment approach. U.S. CIF, in reality, talks about impact investing across all asset classes, because we don't believe that a private equity investment or a direct investment is the only way or even the most important way to make impact. So that's our definitional strategy. It's different, not only in different parts of the world, but by different managers and investors in the U.S. So I don't think there is clarity. We would like there to be clarity. But I do think it's important when you have a conversation to define at least how you're talking about it, so that you know whether you're having a similar conversation or not.
So the debate's happening. Simon O'Connor in Australasia, and then to you, Flavia.
Yeah. Widely, and that's about measurability and intentionality. So I think there's a risk here that people start retrofitting their products to be impact product when that was not in intention. But I agree with Lisa. We look at impact investing as something that can be allocated across asset classes and across strategy types. So it's not just equity investment. There's certainly room for impact across a lot of different assets. But we do expect to see very clear, measurable social and/or environmental outcomes that should be reported up there alongside financial outcomes. So I think this is a really important conversation. It's one we have just launched an Impact Investing Forum as an arm of our organisation because we do see impact moving to scale and moving towards institutional markets. But at the moment, there's a real focus on that point of difference, which is really the intentionality and the measurability primarily. But equally, I think additionality is something we think about quite a bit in impact.
Okay. Flavia, you've got dozens of marks. Just the very highlights, please. The
Yes.
Eurosif view.
Thank you, Simon. We've been tracking the developments of impact investing since 2012, expanding the scope, especially in the last two studies, in order to include specialized niche investors. And what we've done, especially this year, is keep on tracking the main factors that drive investors to choose impact investing. And we did that also while looking at barriers and incentives to this strategy. When looking at the hurdles for investors, we continue to see the lack of viable products and options, while investors are continuing to look for possibilities to scale and match the institutional minimum investment sizes, and having a track record and investment characteristics that match their asset allocation constraints. The risks, which have already been highlighted in the different geographies, really concern and are very much linked to the lack of metrics, linked to the fact that indeed there is no one definition of impact investing today, and clearly hamper comparability with repercussions on the due diligence process for investors. So clearly another strategy which needs further clarity in terms of metrics and definition of what it can really deliver in terms of impact.
Yeah, okay, so a big issue, and no doubt one which will feature largely in the next edition of the study. Linked to that, a couple of people have asked, do we have plans to review the balance of SRI assets that are managed actively, passively, and via smart beta strategies? And I think the answer to that is, again, we will shortly begin the planning work for the next edition. I think we will have to look into that. Linked to that, a question from Beatriz Calderon. Do you have a plan to get responsible investment data from the Latin American region? I think the answer is yes.
Yes.
Lisa, did you tell me you had met some of our friends from Latin America recently?
Yeah, there's actually a sidebar in the study which all can download off of the US SIF website, the GSIA website, and probably some of the other individual SIF websites. We do have a sidebar from Latin America. Working hard to create a sustainable investment organization. It's very early days, but they're in touch with many of us to get assistance and help grow. And we hope, over the next 5 years that there will be sufficient small scale happening there that they will be able to produce a report that we can include in our report, the broader report. I'd also add that there is an interesting story, again, another sidebar in the report on South Africa. And again, a place where we hope that, West, Southern, Eastern Africa at some point will be able to produce reports on the sort of trends and size of the market, that we would love to make this report more international than it already is.
Yeah, thanks, Lisa. Question here. This study is a tremendous piece of work. What can asset managers do to make it easier for you? I think that may go to Meg, if you're still on the line, Meg. You sort of pull the data together. Any answers to that?
Yes, well, I would say, yes. I would say if you're contacted by any of the GSIA members for the regional surveys, please respond to the survey. That helps us enormously. I know, speaking for the U.S. research process that produces the U.S. SIF Trends Report, if we don't get a response to our survey from asset managers, we will do a lot of research online. We'll try to find sources such as filings to the Securities and Exchange Commission. We'll look at the asset managers' websites, but it's really helpful if we get direct information from asset managers, and the more data we have, the stronger the report is.
Yeah, so there's a bit of a deal there. We must ask the right sensible questions, and in return, the fund managers and the asset owners please answer. Okay, Another question coming up, this one to Simon O'Connor. Why has the tobacco divestment such an impact this time round when it has arguably not invested previously? Simon, what do you make of that one?
Yeah, I think that's a really good question because the tobacco divestment is almost going back to the future a little bit. It's almost like a ethical investment issue of 20 years ago. This time round, I think the industry, so taking it from the perspective of where I am in the Southern Hemisphere, in Australia and New Zealand, I think the industry is in a place where they are much more willing to use the full suite of responsible and sustainable investment strategies available to them, the full set of tools in the kit bag. So those who traditionally might have done only ESG are much more willing to do some selective exclusions today. Equally, those who traditionally have used selective exclusions purely are more comfortable using ESG integration and corporate engagement and other strategies. So I think it comes at a time where responsible and sustainable investors, probably the world over, are more willing to flex their ownership muscle and actually take more of a stewardship approach and really think of the values of their underlying beneficiaries. And I think where there's one issue that fairly universally many of those beneficiaries would not be willing to support, that is an industry such as tobacco that ultimately kills its customers. So I think it's really come at a time where there's been a favourable environment to it. Equally, I would say there's a very, very strong campaign underpinning it from a very compelling campaigner who is an oncologist who is travelling the world right now, speaking to many of the asset owners in your markets to convince them of it. And so she's quite a convincing campaigner. So I think it's been a good, it makes a very good, compelling case as to why this should be divested from.
Yeah, she's a very effective campaigner. She's presented many times in the UK here. Question to Flavia. You mentioned the SDGs. Do you think they might bring the disparate nature of the various European markets together? Do you think they'll boost commonality?
I think there are very good chances to do so, in fact, because we are seeing also many efforts on the European legislative side. As you know, the European Commission has recently launched a call for tender in order to create a platform of experts, sort of another high-level group, which can help them in terms of advising on which and how to focus on being able to really deploy a strategy which makes sense at European level and which can at the same time allow to bring in all the relevant parties and which can show the way to private investors, which indeed will be the driving force behind SDGs. I must say that here in Brussels, the topic is very hot at the moment. SDG and investment is something which indeed is becoming more and more important. And I might not have mentioned that before, but indeed the SDGs and the UN 2030 strategy are actually directly mentioned in the CMU midterm review as part of the way the Capital Markets Union would indeed be implemented. So I would say there are very good chances that the efforts made at European level will bring some ways of working that different member states in Europe can agree on.
Okay, thank you, Flavia. It was bound to come up. Lisa, President Trump, will his action in seeking to renegotiate the Paris Agreement discourage US investors or encourage them? Your thoughts on that, please.
Sure. We put our trends report out, the U.S. trends report out about a week after the election. So this has been one of those questions that we've been answering since. And so I think about it in two buckets. One is that, regardless of who won this election, I would have thought that sustainable and impact investing would have continued to grow in the United States. It has just reached, a level of acceptance, and there's so much demand that more and more of the conventional firms who have not shown interest in this before are now understanding that if they don't supply this expertise, they will lose clients, and that's certainly led to enter the space. So I think that would have been a given. What I think Trump does in some ways is possibly accelerated, and here's why. Right now, we don't have the federal government anymore as a place to address environmental, social, and governance issues in the way that sustainable investors care about them. Certainly in the U.S., sustainable investors oftentimes are engaged in policy as well. And so you're really left with minimal private sector and trying to continue to influence them as our field has done so long and so well. And you're left with states, and to a lesser degree cities, but it's easier to get sort of systemic change more broadly at the state level. So I do think that folks may look at their investments as an opportunity, as a way to drive environmental and social issues forward with the federal government sort of closed for business. So I think it will help in that way. You know, the downside of that is that we will be looking at potential rollbacks on a lot of the policy issues USF and others have worked on over the years. Certainly the Global Sustainable Investment Alliance has taken positions on ESG reporting and disclosure and climate and, you know, as Flavia just said, human rights and a range of other issues in the SDGs. That is fundamentally altered now in the United States. And so that is, you know, while ESG assets may rise, we also will see a government that increasingly doesn't address the important issues we care about, and also is creating an extraordinarily deregulatory environment, which I certainly don't think is going to uphold issues of concern like greater ESG disclosure by the Securities and Exchange Commission. So probably continued growth may enhance growth of ESG assets, but at the same time will undercut in a very important base of policy and legislation related to important ESG issues.
Yeah. Yeah, well, I wish you the best of luck with that, Lisa, as you know. Okay, the last question we've had so far. So I had one more question to go. If you want to ask the question, you better start typing. Question from Jeremy Robinson here in the UK. I think what Jeremy is asking is, are benchmarked assets in a passive fund liable to greenwashing? Shouldn't responsible investment be about active stock picking based on the defined strategy of the company and the methods of the fund manager? So I suppose the question to the three chief execs is you know, shouldn't we as a sector be trying to direct money to the good guys? Shouldn't we be looking for people with a commitment? Slightly philosophical question there. Do you start that? Should we be looking, you know, mainly for the good guys?
Who's the question directed to?
That was to Flavia in the first instance. Maybe you're on mute, Flavia.
Sorry, Simon, you just cut off there. Yes, I completely agree with that, and I think that this has been consistent with the approach we took at Eurosif for our study, and I think that going forward it will remain to be an issue for discussion, and indeed, as you can imagine, there is a lot of talks about what, as SRI always evolves in itself, it is indeed a matter that raises different questions, and there are different parties that come to the discussion. But I personally share the more positive and the more engaged view of investors in this sense, so the more in the most active sense, and I think that going forward we will remain to take the same stand.
Okay, Simon O'Connor, the Australian view on that topic. You support the most active people, I suppose it is.
Yeah, I don't think there is a single Australian view. I think that's certainly one school of thought. I'd say in addition to Flavia, I don't think that a passive investing strategy means that you are not acting with, or it's not possible to act as an active owner through engagement and through other stewardship strategies. And I think the onus really is on investors to demonstrably articulate how they are actually acting to influence corporate behaviour through engagement, if they are taking a passive strategy or if they're holding companies. And I think what we're starting to see is much more examples of how corporate behaviour is in fact being changed from investments in companies as opposed to just divestments. I think the voting at climate resolutions is a really prime example of that. We've seen the most powerful one of those recently with the ExxonMobil vote in support of the climate resolution there. And we've certainly seen examples in our markets of where engagement is starting to have very real impacts. So there was another gas company in Australia recently where there was a big push from investors who owned that company to influence their climate strategies and scenario planning as well. So I think we really do need to start being able to talk and point to examples of engagement actually having an impact in order to justify the fact that ownership can also influence issuers and investee companies.
Okay, thank you. Lisa, comments from America?
Sure. I'll go back to my comment on ESG integration, which is, when US CIF did its strategic plan for 2016 to 2018, we really focused on defining in the rigor of the field, creating more rigor in the field, ensuring that firms that were coming in at a fairly low level of engagement in the shareholder process and a poorly defined approach to ESG integration would continue to sort of move up the scale of a more rigorous and extensive approach to sustainable investing. So that is absolutely a laser focus of us for the next several years. I think all of my colleagues from the GSIA were very pleased and have been very keen on PRI beginning a delisting process, because we don't feel it serves the field to have firms who can't describe what they're doing or how they're doing it to say they're doing sustainable impact investing. So, the great news is we're all here to advance the field. I think everybody on this call has played an important role on that, but I think we are equally responsible for ensuring that the development of the field is rigorous, it is accountable, it is transparent, all the things we ask of companies. And so, those are the things we'll be focusing on in the next several years.
Okay.
And this is,
well, we're going
I would just add with regard to the passively managed investments, there are ESG indexes, SRI indexes, so it could be passively managed to an SRI index, and I agree with Simon O'Connor that how the fund manager votes proxies and engages in shareholder action is especially critical for passively managed funds.
Yeah. Okay, well, we're out of time now. We're going to have to bring it to an end. I'd like to thank everyone who's joined the webinar. It's clear that global sustainable responsible investment, I think, is definitely on the upswing. Lisa in the States, to a lesser extent, we in the UK. Some issues with political and the degree to which we can rely on regulatory input to drive things, but the momentum I sense around the world is very strong. So on that high note, we'll draw the webinar to a close. Thanks very much for joining. Thanks to Bloomberg for sponsoring the study. Thanks to Lisa, Meg, Flavia and Simon for speaking. Goodbye, everybody.